And 3, 2, 1. Welcome to the show.
Welcome to the show. It's almost the Ides of March.
I don't know what that is. I'm just kidding.
You must have read about that in high school, didn't you?
Yeah. All I'm thinking about right now is our new set. I mean, I think we had it last show, but we're slowly getting things, tinkered with. If you want to leave a comment about how weird the lighting looks, I'll save your breath. We know. We're still trying to figure it out.
They may leave comments about the plants or the steins.
I can't see the plants yet. There's the plants.
There's the plants. Can you see the steins there or no?
They're peeking out around the corner. Yeah, it's beer and plants.
That's pretty much all you need. Gifts from the gods. Man, it's crazy because yesterday I'm trying to put this slide deck together and I had writer's block. And by the time I got home last night, there was more stuff to talk about than I can't even do it. Yeah. So it's Friday morning, so we'll see. I got the charts, through Thursday, through yesterday's close. Mm-hmm. Today, it's certainly starting off as another rough day. The banking sector got absolutely killed yesterday, led by this Silicon Valley Bank. And the big question is going to be, does the jobs numbers came out? I didn't even have a chance to look at that this morning. But if inflationary pressures keep going and the Fed keeps raising rates, which they said they're going to do to push inflation down to 2%, if jobs keep coming in strong and inflation pressures are still there, and the Fed keeps raising rates, that only furthers this idea that they're going to break something. And it's certainly possible that this thing that happened yesterday in the banking sector could definitely be a thing that breaks. And so...
And when we say banking sector, do we mean the whole banking sector or that sector of the banking sector, that area? Because it's not massively surprising that they're having issues because tech's having issues, right?
Right. That particular bank.
Yeah.
But yesterday, the sector, the bank, the NASDAQ, the BKK or the BKX, whichever you looked at, was down like 8%. I mean, the banking sector got killed. And there were some individual banks that got really clobbered. But like the Silicon Valley Bank was down 60-something% yesterday. Then it was off like 45%, and then they stopped trading in pre-market because it's a short squeeze. Like if you could buy, if I could buy it right now, it's I don't know about right now as we speak, but you couldn't trade it first thing this morning.
You'll know on Sunday when this comes out.
Oh yeah. I mean, the pre-market price when we sat down to do this was like $39. It was $800 beginning like early 2021.
Yeah.
So anyway, this could be, this particular bank is a problem, but it's a bigger banking sector problem. The thing that's weird is in 2008, it was a banking real estate, they call it the Great Financial Crisis. It's very, it never happens. It's the same exact problem that happens twice in a row. So everybody's saying, no, it's not going to be anything like 2008 because the banks are all, much better shored up and we don't have the same systemic risks and all that.
Maybe,
but maybe not. It could look the same, but for different reasons behind the scenes. You know what I mean? It's some really interesting stuff going on out there. But at the end of the day, it really doesn't change at all the way that we would manage TSP.
No. I mean, there's always going to be things that impact it, regardless of what sectors we're talking about, right? Because we're dealing with the big, the SP 500 and the S fund. Those are large indexes, and if something like this happens, it's going to impact it. But we're going to treat it the same.
Yeah.
If it's on a downward trend, it's on a downward trend.
It's in a trend, right.
If it's an upper trend, it's an upper trend. Yeah. If it's going sideways, we're freaking out. No, I'm just kidding.
Yeah, that is true. Sideways is the worst for us.
Yeah.
All right. So this is going to be an interesting show, actually, what I got put together here, because to be honest, one of the pieces of it, we're gonna look at the Golden Cross, and it's actually bullish for a bunch of reasons, and we'll talk about it. All right. So Market sentiment, which is a good one to kind of do a refresher on. We're going to look at market sentiment, and one of the ways you can gauge market sentiment is looking at this thing called the CNN's Fear and Greed Index. We've talked about it before. It's a pretty easy kind of generic way to get an idea of market sentiment, and then we'll go into what the Golden Cross is, and then I got one chart on the short term, like where we are on the S&P 500, which is our C fund, and then we'll do the weekly charts. All right. So just in general, right, what is market sentiment? And this is the definition from Investopedia. It refers to the overall attitude of investors towards a particular security or financial market. So generally, I would look at it as the sentiment of a financial market, but it's the feeling or tone of the market, right? It's how people feel about it. It's crowd psychology, right? There's nothing factual about it. The basis of it can be, but it's really a way to try to gauge how people feel, as revealed through the activity of price movement of securities traded in that market. So in broad terms, rising prices indicate bullish market sentiment, right? Obviously, when prices are going up, people feel more confident in the market. And we've seen that since the October low. When prices are falling, people are more bearish on the market. And when they get to extremes, which is what they're trying to capture in the CNN Fear and Greed Index, because when they get to extremes one way or another, then that's when the market tends to flip. All right. So if we're using the CNN Fear and Greed Index, right, here's the link to it. What is the CNN Fear and Greed Index, right? It's a way to gauge stock market movements and whether stocks are fairly priced. The theory is based on logic that excessive fear tends to drive prices down, and too much greed tends to have the opposite effect. So it's calculated how it's calculated. How often is Fear and Greed Index calculated? It's pretty much minute to minute. If you look at it at that link, it changes pretty consistently throughout the day. And how would you use the Fear and Greed Index? Used to gauge the mood of the market. Again, it's trying to capture sentiment. So many investors are emotionally and reactionary, and fear and greed sentiment indicators can alert investors to their own emotions and biases that can influence their decisions. We talk about that all the time. So when combined with fundamentals and other analytical tools, the index can be a helpful way to assess market sentiment. All right. So yesterday, here's where we were, Fear and Greed Index. So it goes from extreme greed to extreme fear. And they break it down a bunch of different ways. They show you, the previous close, the 1 year, the 1 month. And so this is a kind of a useful way to look at it, to get a snapshot. I like this one better. So if you go to the homepage, this is what you see. If you flip this toggle to timeline, this is what you get. Okay. And I like this one a lot better because it shows you fear and greed over time and not just a snapshot of what it is at that moment when they do it. So what do we mean here? Extreme greed is above this 75 line. And extreme fear is below this 25 line. So extreme greed, for example, is consistent with the August high, right? Extreme fear is consistent with the October low. Okay, so when we get above the extreme greed lines, we're looking for the market to roll over. It doesn't mean you would sell it as soon as it gets up there, at extreme greed. But one of the things you can look at is the high in February. People were even more greedy, right? The extreme greed reading is higher than it was at the top in August, even though price hadn't gotten there yet. So that was an indication that, we were more likely than not nearing a top. So that's one way you can. It's not a timing tool, right? But it's pretty useful. When we do get into these levels, it's pretty useful. So this was as of yesterday's close. Where's the time on here? Yeah, this is yesterday's close. So if the market closes down today, really big let's say, and we're down here at 25, that indicates that we're getting closer to a bottom, right? A short-term bottom anyway. So we'll have to see. All right. So it's made up of 7 sort of different components is what makes up the overall fear and greed index. So market momentum, useful to look at stock market levels compared to where they've been over the past few months. Momentum is a pretty good one. And they use, in this case, the 125-day moving average. So when S&P is above its moving average or rolling average of the prior 125 days, that's the 125-day moving average, that's a sign of positive momentum. But if the index is below that moving average line, it shows investors are getting skittish, right? And it's fear in this case, because even though it's above, it's pretty much right on that line as of yesterday's close, the direction is down, right? So it gives it a fear rating. Stock price strength. A few big stocks can skew returns for the market, right? We all know that the FANG stocks tend to drive the S&P 500. So it's important to also know how many stocks are doing well versus the number that are struggling. So it's what's happening within the index. And this shows the number of stocks on the New York Stock Exchange at 52-week highs compared to those at 52-week lows. So it makes sense that, here was the February high, and a big number of stocks are at all-time highs versus all-time lows. And so this chart in this time frame, since the bear market began at the top in January 2022, that's why we have a lot of negative numbers down here. So it's kind of skewed because we've been in this bear market for so long. But basically, if you're at a high relative to these past highs, then from a relative basis over the past year, we have way more stocks at 52-week highs versus where it was down here at the low in October. So that gets agreed. And you get stock price breadth, right? Market's made up of thousands of stocks. On any given day, investors actively buying and selling. The measure looks at the amount or the volume of shares on the New York Stock Exchange that are rising compared to the number of shares that are falling. So a low or a negative number is bearish, and the Fear and Greed Index uses decreasing trading volume as a signal for that fear. So we are definitely in a downtrend in breadth. So there's more volume to the downside, which is a fear indicator. Put call ratios are a really important one. The higher the number gets up here, it's a higher indicator of fear. And so obviously down here in February, there were very few people buying puts relative to calls. So a put is a bet that the market is going to go down, and a call is a bet that the market's going to go up. So the ratio of the two, when it spikes, there are more people betting that the market is going to go down. And when it's down here, there are more people betting that the market's going to go up. And right now, that's fear. And you got market volatility, which is generally the biggest market volatility indicator is the VIX. We talked about the VIX within the last couple of shows. VIX measures expected price fluctuations or volatility in S&P 500 index options over the next 30 days, right? It's looking out. It's a fear index where the options market expects the price to be over the next 30 days. So the VIX drops on days when the broader market rallies. The VIX is tied to the S&P 500 options. So generally speaking, when the S&P 500 goes up, the VIX goes down, right? Because it's measuring fear. So when the price goes up, fear goes down, and vice versa. And as of, you can see yesterday's close, it was a big down day, so we had a spike up, and so fear. And then safe haven demand, the difference between 20-day stocks and bond returns. It's not so valuable since the top in 22 because stocks and bonds have been moving up and down together. But in general, stocks are riskier than bonds, but the reward for investing in stocks over the long haul is greater. Still, bonds can outperform stocks over short periods, right? So safe haven demand shows the difference between treasury bond and stock returns over the past 20 trading days. Bonds do better when investors are scared, right? So the bonds go up. Theoretically, bonds go up because people are leaving the stock market and going into the bond market. Bonds do better, when investors are scared. Fear and greed index uses increasing safe haven demand as a signal of fear. So you can see the last week or so has collapsed, and they gave it an extreme fear rating. And then the last one is junk bonds. The demand for junk bonds. So this is a pretty good chart of when they talk about credit spread. Junk bonds versus investment grade bonds. Junk bonds carry a higher risk of default because they're smaller companies, right? They're riskier bonds. So bond yields, well, the return you get on investing in a bond dips when prices go up. So if investors crave junk bonds, the yields drop. If investors are craving junk bonds, the stock market is going up also. And likewise, when yields rise, when people are selling. So a small difference or a spread between yields for junk bonds and safer government bonds is a sign that investors are taking on more risk. So when the numbers are higher, investors are taking on more risk. When the numbers fall, investors are fleeing risk, which is why you get an extreme fear here because this thing spiked down over the last week or so. So CNN takes all those and puts them together and gives you that overall fear and greed index using those 7 sort of metrics. So it's a pretty good way to get where we are that day. And if you look at the one that has the chart over time, I think that's a pretty good one to look at. Okay. This one, Golden Cross, this is interesting because now we're coming off of this whole thing we just did about fear and greed, and obviously there's a lot of fear in the market, and today it's only going to be worse, right? So on the one hand, it's interesting because as that fear and greed number comes down, it's more fear, right? The lower the number, the more excessive fear is, and that definitely tends to mark at least a short-term bottom in the market, right? Maybe it's consistent with what we're going to talk about here on the Golden Cross. We'll see. So Golden Cross, right? The definition of a Golden Cross is when the 50-day moving average line crosses up through the 200-day moving average line. Okay. So in this chart, the 50-day is the green line, and the 200-day is the red line. Okay. And the reverse of that is a death cross. When the 50-day crosses down through the 200-day, it's a death cross. So a couple important things here. The really 2 things. A golden cross, okay, is when the 50-day crosses up through the 200-day. Right? It doesn't happen all that often, but quite a bit. And so what tends to happen when the 50-day crosses up through the 200-day is you get a relatively long stretch of bullish price action, right? And the really interesting thing is there aren't any failures in it. There are failures sometimes on the death cross. So the death cross, when the 50 crosses down through the 200, right? You see right here, it failed. It only stayed down there for a few months and then turned back up, right? So you tend to get way more failures in the death cross than you do on the golden cross. So when the 50 crosses up through that 200, you almost, literally always, you get a pretty long amount of time where it stays up above it, right? But on the death cross, it's not always the same. And a lot of times, the death cross actually indicates a market bottom. So, let's just use this for example. By the time the cross actually happens, it tends to be a bottom, and then it turns back up the other way. So it's almost, in short term, it's almost better to use the actual crossing to the downside when the 50-day crosses down through the 200-day. it's almost better to look at it as if a bottom is going to be taking place pretty soon. So if we go to the next one, I just wanted to show going all the way back, like, what is that, 97? I mean, what is this? I can't even read it. Is this 97 right there? You see that?
It's smaller on my screen than on yours.
It's so small on my screen. I can't. We got to figure out a better way to do this.
We're old and blind.
Yeah. Anyway, once the 50 got above, the green line gets above the red line, it stays there for a long time. And we had a little fake out here, like I said, when the death cross didn't last very long, right? And then we had another golden cross. And we had another long period where it stayed above it, right? And then once it crossed below it here, it stayed below it for a long time. Anyway, I just wanted to point out this part right here. There's a lot of talk about the possibility of here's where we are relative to where we were in 2008, right? We just had this, a very similar, we had a move down, and then we had this recovery rally. In 2008, price just barely ticked above that 20-day moving average line, but the 50-day never got back above the 200-day, right? Where we are right now, we had a golden cross happen. So, based on the history of the golden cross, we should expect some amount of time to be for the 50-day to be above the 200-day. And so, if it rolls over right now, it will be very unusual from a historic perspective. We'll see, but it's fascinating because once you get a golden cross, I mean, you're good for a while. So we'll see what happens. So I just want to zoom into a daily chart. We don't usually do this on the show, but there's a lot going on, and we had put out a couple of different market updates over the past week or two about this. So I just wanted to kind of talk about it a little bit.
Yeah, the market updates, just to be clear when people are listening, when Jerry does a market update, he does a video kind of analysis, at any given time during the week, and that just goes out to members. So if you're not a member of the site, you won't see those. But we occasionally share them publicly after we've done them. But that's the kind of stuff you get if you're a member. Just pointing that out. Yeah,
I did share out one market update within the last week or two, and it was all about this area right here. You got the 50-day. Well, here was the golden cross, right? That's where the green line went up through the red line. And so from any historical time period, if you look at it, we should be going higher. And so in 2008, if you remember the chart we just looked at, we had this down move, and we had a rally in price, but it never got above that 200-day moving average line, and then it rolled over and went way down, right? So it'll be interesting to see if this golden cross matters or not. Because if the market rolls over here and keeps going down, and the green line now crosses down through the red line, we will not have seen that happen. I went back about 50 years and I couldn't find it where it was basically a head fake of the golden cross. You get a head fake of the death cross all the time, but you don't usually get head fakes of the golden cross. So we'll see. But the market update was all about where the long-term downtrend line, the short-term uptrend line, the 50-day moving average, and the 200-day moving average were all converging right here. And we said anywhere in here could be a support zone. And we got support for 2 days. And then the market rolled over. And as of yesterday's close, it was below that support zone. We said the support zone was 39.30 to 39.80. And as of yesterday's close, it closed below there. And it's continuing down today. So in the short term, the market is not looking good. All right. So how does that really affect how, if you are following TSP on a weekly basis, this is why we do the weekly charts. Again, this is through the close on Thursday. So it's a pretty bearish week. You got a bearish engulfing candle that is engulfing the last 2 weeks of price movement. So if we closed it down today at around that 39.15, say 3900 level, it's a pretty serious break down through that 20-week moving average line. And this isn't so much a timing tool that I'm trying to get across on these charts. It's the 20-week moving average line. If price is below that line, there's no chance that we're getting a sustained rally. So it's not necessarily that you want to buy it and sell it when it goes above and below that line. Mm-hmm. You have to pick a time that you're going to buy it and sell it. But the overall idea is that you want to be in the stock funds when the market's trending up. And when it's below that line, it cannot,
it's
by
not
definition, by math, it's not trending up, right? So that's all we're really trying to get across. And then that gets supported by where the technical indicators are, right? So in this case, as of Thursday, we're below that line. RSI is below 50, and MACD it's still positive, but it's clearly rolling over. So now is not the time to be in the C fund. Having said that, we are we're just barely below that support level. So it could turn back around, but the odds, the longer it stays below that 20-week moving average line, the less likely it's going to find support there. S fund is worse. It was a pretty big down week for the S fund. S fund was, holding up relatively well, but this completely collapsed this week, and now it's back down below its 20-week moving average line. RSI below 50, and MACD still a little bit positive, but definitely declining. I fund is actually holding up the best. It's still above its 20-week moving average line. Took out all of last week's gains, but still above it, still above 50 on RSI, and has not crossed yet to the downside in MACD, but it is kind of starting to roll over. iFund can hold up longer. It obviously had a better rally off the lows in October, and it could hold up longer than the C and the S funds. But at the end of the day, if the C and S funds really roll over, the I fund is definitely going with it. You're not going to see the I fund keep moving higher and the C and S funds move significantly down. You're not going to get that kind of divergence. And the F fund is probably the most important thing to watch right now. So we haven't talked about it in a few weeks, but we were talking about it in the beginning of the year. The idea, the general thesis for the year was that stocks collapse, investors flee to the safety of bonds, so bonds go up, stocks go down, and the F fund, right, is our only bond fund. The F fund goes up. You can't see it on this chart, but and I'm not 100% sure actually that. Well, I'm pretty sure the F fund is gonna close much higher today, and so we're probably going to be back above that 20-week moving average line in the F fund. It wouldn't surprise me at all by the end of the day if we're positive above 50 RSI and MACD turns back around and goes positive. We've been talking about how since the top in January, back here in 2022, the bond market and the stock market have been moving up and down in tandem. And at some point, there's going to be a split. And, today could very well be the beginning of that split. We'll have to see. But the F fund is definitely something to watch, because if the stock funds tank and the F fund goes up, it will be back to how the market is supposed to work, right? When stocks go down, bonds go up. That's the idea. It hasn't been the case since the beginning of 22, but bonds are historically so oversold right now. There's potential to make a lot of money in the F fund this year. If stocks are beginning to really roll over here, and if you see the F fund go up over the next few days as the stock funds go down, F fund is going to be the place to be. Yeah. I think it was a little bit of a quick one, but there's a lot of good stuff in there.
Questions. If you have questions, you can put them in the comments section wherever you find this video. Best way to get a hold of us, if you don't see a comment section, is to put it to support@growmytsp.com. they will make it. It will make its way to
Its way to us, for sure.
I haven't had enough coffee this morning, man. I didn't do a lot of talking, man. You were just on a groove.
Yeah,
whenever I don't interrupt you, it's a lot faster.
There's so much going on. I'm really curious to see what happens for the rest of the day. Again, if you're watching this on a weekly basis, the biggest thing is the. Let me see where it closes for the week.
Mm-hmm.
I'll put it out tonight. Like I do every Friday night. The market this week. Little slide that I do, and you can look at that with respect to the charts that we went over, and we're below that 20-week moving average line, and we had a big bearish reversal candle, engulfing candle this week. So the stock funds are not looking good.
Yeah. Give us all the doom and gloom, man.
Now, so yeah, I mean, on the other hand, that bullish Golden Cross is a big deal because I went back, decades, and I couldn't find an example where the bullish cross, Golden Cross happened, and then a few weeks, even a few months later, it rolled over and crossed back down. There's plenty of examples of the other way, but not when you have a bullish breakout like that. So even though all the macro indicators are saying the price should go down, if you're looking at that Golden Cross and how it's happened historically, there's historical precedent is that the market keeps going higher, but that flies in the face of pretty much everything else.
Right. All right, guys, if you like this, make sure you share it with your friends, tell your buddies. If you're a member, make sure you are reading the newsletter every Sunday night.
Yep.
I mean, you don't have to read it Sunday night if you want to read it on Monday. Jerry always does a video where he walks and talks his way through it. And if you're not a member, I don't understand why.
Sign up.
All right, guys. Hope you have a great weekend and a great week coming up.
Out of here.
Boom.